All right. Good morning, good morning, good morning. How you doing? Market's going to open here in just a few minutes, and we are staring at the S&P 500. This is the mini contract. Over on the left-hand side, we have a 1-minute chart. The right-hand side, we have a range bar 6 chart. For those of you who don't know who I am, just to give you a quick introduction, my name is Lan Turner. I'm a former instructor at the Chicago Mercantile Exchange and the Board of Education Center, and currently an instructor of finance at Utah Tech University. And I'm happy to be here with you. This is generally where we bring our students from the university and we practice what we preach. So we do the academic work over at the university, and then we come here, and this is where we practice the things that we learn in class. All right. So I'm very happy to welcome everybody from class. I also, since this is on YouTube, the whole world is invited. You are all invited to come and play with us and learn and work and study and practice. If you know everything, if you're already one of those guys that knows everything there is about trading, then you don't need to be here, because this is an educational forum. This is where we learn to trade. And if you're already rich beyond your wildest dreams, and you know everything there is to know about trading and you got it all figured out, there's another channel for you somewhere else. All right. This is for people who want to learn. Right, and practice, and we test things, we look at stuff, we try things out, we don't pretend like we know everything, we're not know-it-alls, we're know-it-nothings, all right? And so what we're trying to do is we're just trying to figure stuff out. And so we're going to work really hard to try and practice and learn and figure out the very best ways to do things. All right, so what we're doing here today is we're going to learn a little bit about, out on the little marquee, on the little thumbnail, we talked about a married put. And I want to talk about a married put because it kind of goes hand in hand with what we've been talking about a little bit with some of our option strategies, the skew, and some of that kind of stuff. And I kind of wanted to introduce something new. We've been quite myopically focused on this wild eye, crazy eye, iron butterfly. And I want to do something new. I want to try something a little bit new. I just want to introduce something a little bit different to you. And then I want to, again, put on another wild eye, crazy eye, but I want to try something different again. Again, that's what we do here in this class is we try stuff. We look at things, we practice, we learn, right? So we're going to try something new once again on our wild eye, crazy eye, iron butterfly. All right, let's see. We got to, let's delete this one for now. And we got to bring, this is the Russell. We're going to bring the Russell, the Dow. I like the Dow up here. And that means we bring the Russell up there. All right, there's the market open, and the market's taking off like a rocket ship, and here it is, rallying, taking off. Look at the S&P. The 1-minute S&P is trying to blast up higher. Here's the VWAP, so it's already taken off, left the VWAP. Yesterday was quite an interesting day. And I've got several comments from people who mentioned that they traded yesterday. I traded real money yesterday. And I need to tell you what happened here in our demo account because we set up some testing environments. And so we need to review that. And then I traded real money yesterday I put on a wild eye, crazy eye, iron butterfly myself yesterday with the real money account. I need to tell you what happened there. And then I had to day trade myself out of that market just flushed, didn't it? Yesterday. I mean, it flushed here while we were trading, and man, it came crashing down. And then it started to go sideways. And I thought, well, it's done. It's just going to die right here. And I thought, well, I'll wait until it comes back up to the VWAP to put my wild eye on. And it never did come up to the VWAP. It just kind of sat there and started to dawdle along sideways. And I was like, well, it looks like that's where it's going to sit. So I went and put my wild eye, crazy eye right there where that market, the S&P yesterday was just kind of dead. About an hour after class was over, just after class was over. And man alive, I timed it perfectly. I was such a perfect good timer. I couldn't have timed it any better. The minute I put my wild eye, crazy eye, iron butterfly on, and we all know that's a neutral option strategy, which means you don't want the market to move. You want the market to be dead, right? That thing lit a fire like it had nitrous oxide gasoline in its tank, and it flushed like a rocket. And of course, guess what happened to my wild eye, crazy eye, butterfly? Went seriously negative very quickly. All right. So I darn near got full profit on the sold call, right? Because when you buy a call, you want the market to go up, and that's how you make money. But when you sell a call, which is what I had done, you want the market to go down. And so it did, and it flashed, and I made full profit in about 1 hour or less. In about it was like 45 minutes. I had full profit on my sold call. And so, but that meant that my sold put, which of course, if you sell a put, you want the market to go up, and it didn't. It went down, and the put skew wiped me out. Right? I mean, man, it was down like, I don't know, $900 or something, and my call option was up only like $300, so I was down like $600, and my insurance premium didn't cover it well enough. I mean, it was there and it was working and it was trying, it was trying, just wasn't quite cutting it and wasn't covering my losses. So I was down like $500 yesterday, and that's a lot of money for me. I don't want to be down $500. That's house payment. Well, not anymore nowadays. Nowadays, that's dinner out with your wife. So I was down dinner out with my wife. So anyway, that's what happened yesterday. And so I started to day trade, and the market did actually turn around and come back. What I did is I liquidated the full profit leg. I mean, I'm like, I'm at full profit, can't make any more. And if the market turns and comes back, all I can do is lose. So I got nothing to lose and everything to gain. So I took off I legged out. Look at this market. Look at it go, giving us an opportunity. Not quite yet. Seeing too many topping tails and bottoming tails. Let's see, it's kind of whipping up and around here. So I ended up taking off the one leg, took off the profitable leg because it was almost max profit. Nothing else to gain and everything to lose. So I took that one off, and then the market, all I had to do is rebound and come back up, and it would cover my losses, right? Come back to the VWAP. Well, I sat and waited and waited and waited, and it kept going down and down and down. So I started to hedge my position. I started hedging with contracts, started day trade against it. So anytime it started to fall, I would take a short position and just hedge my position, stop the bleeding, right? And then it would fall, and I make $300, $400, $500, not enough to cover my losses yet. And then that would turn around and it would put a nice dent into it. So then I'd take that profit off. The market would start to rally back up again slowly and start to make my money back again. And then I have to hedge again. And then I'd hedge on whenever it was going to go down against me, I would put on another position and take the hedge. And I did that for about, it took me about 2 hours. And then finally the market started to go in my favor, and I'd hedged in there and ended up with about $500 of profit day trading, but I was still down about $500 on the market, right, on my options. And so it finally did come back, and my options went back to almost break even, and about $100. Man alive, I'm sitting here talking, and look at this Dow up here. The Dow has really been the best market lately. We kind of go through stretches. The Russells, we're like, why don't you just trade the Russell, Lan? And I'm like, because I like the Dow, and the Russell's the one that always does. But now we're back to the Dow. The Dow's been the shining light here, and it just crossed the VWAP. That's what that purple arrow set tells us. That's the volume weighted average price. And I've got the bulls and bears turned on in here. This is where the market started to turn and went bullish on us. And you can see that arrow right there, leaving the yellow bars to the upside. And man, alive, this thing's going to the moon. But look at the S&P. The S&P's coming right back. Perfect location to be putting on our wild eye, crazy eye on our butterfly. And I want to do a little bit of a different thing. I'm right in the middle of telling my story, but I need to place a trade. So we're going to place our trade right here. Sorry about that. I'm still fighting a little cold. I don't know what happened. I caught a little spring cold. So we're missing it. Like, we want to place our order right here on the VWAP. Well, let's do it. We're on this is a 1 minute chart, so we're okay. Let's go to the 2 minute. We got to find out where the strike's at. I want to put my order on right here. And I want to do something a little bit different with our Wild Eye Crazy Eye again today. So we're going to try something a little bit different with Wild Eye Crazy Eye. We're going to go in here, and traditionally, what have we been doing? We've been coming in here, and we come in and we go like this, right? We buy our call, and we sell our call, and we do that right at the same prices we're selling. So we buy them. We got to do it here, and here's our only choices right here, right? We want to be right there. Okay, so this is buy, and we're gonna buy this one, and we're gonna buy it. Let's go out. Let's see. We need to go look at our options chain. Let's go to 3 days. This is Friday. Friday. What happens if we go up here to this one? That says that one's in the money. This one, either one of those two is going to be acceptable because it's above and below. But I want to show you something. Watch this. We're going to put it right here. Where's the delta? I have to look at the delta. Delta 54, delta 49. I want the. Okay, I'm going to show you something. Okay, so what we're going to do is we're going to buy the insurance policies. Try to decide which one I want here. So we're going to buy these insurance policies, but I'm going to show you a little something I'm going to do here. I'm going to do something different, just a little bit different. We're going to come in here and we're going to buy, how's the spread on this one? $25. Let's go to 2 days. $25, still $25. Okay. All right. We're going to try this one. We're going to do this. I'm going to show you something. We're going to go in here and we're going to buy the put and the call. We need to do them both at 85. So we're going to actually buy these. Okay. So we're going to buy that one and we're going to buy this one. And I want them right on top of each other. I made that mistake. How come they're not on top of each other? I made that mistake yesterday. I've had a little gap between them. Oh, now I'm getting too many. What am I doing here? Lan. We got to buy our call. We're going to do 2 days out. Buy our call. Yeah, to buy that one. And we're going to buy this one. All right. So we're buying them right on top of each other. We're going to do 2 days till expiration. So that's Friday. Friday's expiration. Right? It's not 3 days. Oh, no, it's 3 days. We're going to do 2 days to expiration. A little bit less money, a little bit more sensitive to market movement. We're going to buy those right there. All right. So let's go ahead. And I'm going to use a limit order. The programmers tell me the reason I'm getting slippage is because I'm not using limit orders. 50. So we're going to buy them. We got to go to the ask. So we got to go to 51. We're this is a demo account. So don't freak out. All right. There we go. Oh, rejected. Compound failed. What did I do wrong? Cancel. Try this again. I did a buy. I need to buy a call and I need to buy a put. Okay, let's try again. Go up to 47.25. Bruce, I think the reason you got some slippage in there is because you weren't maybe because you weren't using limit orders. You asked me in the. Okay, so I just bought the call and the put. All right, so that's our insurance policy. I haven't put on the sold yet. So now I'm going to put on the sell options, and we do that on a 0 days till expiration. So we come in here. And we're going to sell these right at the money, right? And that's what we usually do. We come in here and we sell them, and we sell this one, and we sell them right on top of each other. So all 4 orders are at the exact same price. I'm not going to do that today. I'm going to do a little something different. I'm going to move these out 1 level. See that? I want to try something. So this gives us better insurance. Now, I brought the insurance in 2 days till expiration. We could even come in 1 day to expiration, make this really sensitive, and pay a less premium. So we could have tried that. So see how I bracketed it? I got to get these in here, or it's not going to do us any good. So I got to come down to 29. Okay, place that order. All right, so now what we've done is let's make sure we did it right, because I sometimes screw these things up. All right, so what we did is we bought, buy, call, buy, put. All right, we bought the call and we bought the put, and we bought them at 52.80. Okay, so I did that right. And then I bracketed on the outside. The sold ones are now, so this is basically a wild eye, crazy eye, iron condor. It's not a wild eye, crazy eye, iron butterfly anymore. It's an iron condor. And I've made it wild eye. Okay, by using the what I call the theta swap. So how many of you, oh, you can't see this. Let me get this out of the way. So how many of you got Pit News Magazine yesterday and saw the documentation that I wrote for you on the wild eye crazy eye? Yeah. And I started writing that article at the first of the month when we started doing all of the wild eye crazy eye stuff, right? All the sold butterflies we're going to do, and we did lots of experiments. And so that article was kind of written over a period of time, and we started off doing one thing, and then as I got through further into the article, I tested other stuff, and as I got further into the article, I wrote other stuff, and as we got down to the other, I had a summary where I summarized what we had done to that point. And so today I was brainstorming and thinking, and this happened because of yesterday's market, where the market went so far and it blasted away from our neutral option position that we really lost. I lost a whole bunch of money. I was down like this. The sold side was down $1,000, and that's pretty rare. We don't and that was a single. I just did a single, and it was down $1,000 because the market dropped so hard yesterday. I mean, it really just flushed, and I got caught in it. And my insurance policy, although it was a 5-day option, it expired on Friday, and it was supposed to be, because I shortened it up, that makes it more sensitive to the movement of the market, right? It still wasn't as sensitive as the ones that I had sold, and so they didn't do as good a job at covering my hiney. And so I had to mitigate, and I had to go in and I had to day trade myself out of it. And I ended up getting all my money back, and when I closed out the position, I was up $5. So after all that nightmare yesterday of trading, being down over $1,000 at one point, I got it all back to $5. So I was able to do that because I used a combination of legging in and legging out of the option. I took off the one leg that was fully profitable. And then as the market came back to VWAP, I let those two run. And then anytime it turned and started to fall again, I just popped in an order and let it drop, and it just protected it. It just kept it from losing more money, right? And as it would go down, it would turn, and as it started to come back up, I had a trailing stop. It would trail me stop, and it would pull off, $100, $200, $300, and then that would be less that I would have to have the market retrace back all the way back up to my entry points. So by having only hedging to the downside and letting the market return by itself without trying to trade back up too, because that would have been, it would just been too much craziness trying to trade up and down, up and down. I only hedged. So I only took a short position if the market turned and started to fall once again. And I had to do that. Gosh, I probably did it 6 or 8 times. Okay. So that's how I was able to hedge myself into a position where the return of the market returned enough that it got me back to break even. And I was able to take it off at a $5 profit. So although yesterday was a wild and crazy day, I didn't lose any money. All right, so what are we doing here? I've shortened up for this example. This is not our married put, and I want to do this first. I want to do this on the S&P, and then I want to talk to you about the married put. And I wanted to show you the difference between a married put and I don't know if I can do that now because I put this on and we don't have options on the other markets. Maybe we can find one that we can put one on as an example. But this should give us a little bit more sensitive insurance policy. So we've sold our option, and our neutral option position, all it has to do is just go flat and do nothing, right? And today we haven't looked at the economic calendar to even see what we got going here. Here's the economic calendar. 8 o'clock, we have the JOLTS job opening. So not the wisest idea to put on a neutral option strategy when we got a red news event coming on. But I wanted to show you this little strategy that I just did here. What I did is I put on an iron condor, wild eye, crazy eye, iron condor. All right. So, Bruce, you're gonna have to help me come up with We're gonna have to go create a new name. Create wild. I don't know. Wild. I think we're gonna have. I think Wild Eye, Crazy Eye, Iron Condors is a good name. Let's just stick with that one because it's not a traditional condor. What we've done is we've taken the wings instead of have wings out and pushed our orders out farther. We pushed our orders out away from each other so they're not right on top of each other, but we brought our wings to the center. And then we've got a calendar wing, which means that it's longer than the expiration of the ones that we sold. So the ones we sold are 0 days, but we put the ones that we bought at 2 days, and they're actually going to be more sensitive to the market movement because they're at the money and our wings are out a little bit farther. Now we don't collect as much money on the outer wings, but hey, we're still collecting a pretty good little clip of money there. We're collecting in here on the ones that we sold, cost base $1,400. That's a lot of money. $1,400. So we collecting $1,400 if the market will just stay right there, flat, dead center. Of course, it's going to move. It'll move a little bit away, and one of them will go into the profit, and one of them will lose a little bit of money, right? That's the way it's all documented in Pit News Magazine. I show you how that works, where you got a little bit of a buffer to the one side, but you got full profit to the other, and then you got a little bit of a buffer to the other side, and you got full profit to the other. That's why it's important for us to understand what we're doing here individually with each individual option. What is this going to do when I do this? What's this one option going to do? Again, it comes back to that old saying that I've been saying, I trade the S&P 500 with options. I don't trade S&P 500 options. So we want to know what the underlying market is doing, and that's very important to our strategy. And so by coming in here and putting our insurance policy right at the money, it's going to be more sensitive to the movement of the market than our outer wings. Now, we didn't push the wings out very far. We only went them out one click. So it's barely a condor. So maybe we need a Wild Eye, barely the condor, Iron Condor. I don't know. But it's what we're doing is we're playing with the theta swap, which I talk a little bit about in Pit News Magazine. So if you guys don't have Pit News Magazine, we got new guys coming in every day. Swing by. It's our club magazine, and this is what we're talking about right here. And this is the Wild Eye Crazy Iron Butterfly. And so I've reversed this. I've actually reversed this slide here and gone the other direction. And that's what I did today, and that's what I want to practice today. So if we come in here and look, where is Pit News Magazine? For those of you who are new and haven't got Pit News Magazine, you're going to want to come over to pitnews.com, and you get the first 3 months. You can get all this documentation on the Wild Eye Crazy Eye. All the work that we've done in the last month's been documented in Pit News Magazine, this month's issue. You can get this issue and 2 more for only $1. So I want you to try it, and if you love it, great. You don't have to do anything. You'll just be charged $49.95 on your 4th month issue, and then for the next 12 months, you get all 12 months for all 12 issues for $49. But you get the first 3 issues for only $1. And if you don't like it after you've had 3 issues, just cancel it. You don't have to. There's no commitment. You just try it for 3 months. It's $1, and you're going to get all the Wild Eye, Crazy Eye documentation that we've been doing for the last month in that version of Pit News Magazine. And that's what Pit News Magazine is all about. It's all about kind of documenting what we learn here in class, putting out all the documentation and information that we have there for you in that magazine. And so that's why you need the magazine. It's only $1. It's $1 for 3 months. All right. So go get it. And it's a wonderful magazine. Let me see. I'm going to pull it up here. Here's the June issue. You can go for you guys who haven't seen the magazine. Here's the June issue, and that's the cover. I love that cover. Isn't that the neatest cover? Look at that big old bull. He's in a golden suit. I thought that was the classiest little bull suit guy. I thought that was fantastic. Anyway, the magazine comes down here. Let's see if we can come down. Here's the Wild Eye Crazy Eye. We'll skip all the way down to that one. And here it is. There's that amazing butterfly that the ChatGPT created for us. That was AI generated. We told it we were creating an article on Wild Eye Crazy Eye Iron Butterfly to please create us an image. And that's what it came up with. Can you believe that? That's just a gorgeous picture of a Wild Eye Crazy Eye Iron Butterfly right there. It's the funniest thing. So anyway, this is the documentation on that article for you guys. And of course, it's got audio, so you don't have to read it. You can listen to it. So, that's one of the great things about Pit News Magazine. You hit that little button right there and you can listen to it, or you can hit that button right there and you can download the audio and listen to it offline. So that's pretty cool. Take it with you on the airplane. And so look at this wild eye. I said, give me another one. And wild eye, crazy eye. That's just wild eye, crazy eye, iron butterfly. So you got some really fun stuff in here. All right. And so this is all the documentation on how this strategy works. And this is where we're talking about just a single side of it and how a single side works. And then when you add two of them together, that's why you get this view here, all right, of the profit loss center. So that's a profit loss map. And this is all in the Pit News magazine. And then, of course, this is my summary where I summaried up the article right here. And so I wrote this summary of the article. And actually, the audio, you got the audio here. I don't think you can hear that. But if you click that, it plays my audio summary of the article of what we've done this month. But then I wrote this part here, down here. And this, for those of you who don't know, this part down here is not what I recorded. I recorded something different than what I wrote down here. This is just kind of a summary notes of what I talked about. So those are the summary notes of what my wrap up was. So that's what that was, and that's Pit News Magazine, and it goes on. It's got lots of great, wonderful articles in here. But I just wanted to show you the wild eye, crazy eye, iron butterfly, and of course, it's also got one of the things in here. It's also got some trade recommendations. So this will always give you 3 good seasonal trade recommendations in Pit News Magazine. And so that's the magazine for this month. And I would like you to have that. It's only $1. Just go over to pitnews.com and get that article on the wild eye, crazy eye, iron butterfly strategy. And join us over there. And back to what we're doing here. So we've changed it up a little bit. We put the insurance policy at the money, and we put our sold options outside the money. So they're going to be a little bit more sensitive. This should give us better insurance, and it's shouldn't be that much more expensive. You can see the insurance cost is $2,337. And some people are going to look at that and freak out. They're going to say, you spent more money on insurance than what you're making on your premium. Yes, but my insurance has 2 days until expiration. And so I won't lose very much of that premium today. And what we'll do is we'll come in and we'll set this. We can do this. Bruce was mentioning before, he was saying, hey, I went and I took this off at a different price. And I'm wondering, Bruce, how you took it off. Did you take it off with a limit order? Is that why you got a different price than what you expected or anticipated? But and also, were you doing it in the demo account or the real money account? You have to take into account slippage, because you want to make sure you realize that, see this number right here? You have to pay this. $25, $25. So if you're doing 2 of them, you have to pay $50. Now, the little calculator takes that into consideration, the spread. So it shouldn't take that off unless it's covering the spread too. But that's the cost of doing business. That's not a commission or fee. Commissions and fees are on top of that. This is the spread. All right. That's why we want to make sure we're using options that have a high volume, high open interest, and have a very low spread. The $25 is actually a low spread. Doesn't seem like it, but it is. All right. So we're going to come in here. To liquidate this, let's try this again. We're going to come in and make sure we do it right. We're going to liquidate the outside wings. So the 0 DTEs, and we can come it down and do it here in this one here. Find the 0 TE. We just right click on it. We say liquidate multi-leg. And then we can tell it right here. See this little calculator over here? This tells us net loss, net profit. And we can run that up or down, and we can say, well, when it's made a certain dollar amount, just take it off for me. Put a limit order on it, right? So we're going to say, well, when it reaches 25%, we can come in here and we can take it off. Now, usually if I've got a really hard hedge on, I've not been taking it off. I've not been doing the 25% removal and then putting it back on, because I've had a really hard hedge, a really good hedge. Now, this should be a good hedge. I mean, it should be actually more sensitive to the market than what are at the money, because the wings are pushed out a little bit, right? They're pushed out a little bit. So we're not collecting as much money on the sold, but our insurance policy should take the skew into consideration a little bit. And we'll try it like this, and maybe tomorrow we can try it one more time, and we'll push them out even farther. We'll see how far we can push them out. And the idea is that when the market does actually take off and run without us, the insurance policy covers us better than what it did for me yesterday. Yesterday was a really good example of where the insurance policy didn't perform for me as well as I wanted it to. And I've got the screenshots of that, and I want to show you. So we're going to go ahead. We'll just go ahead and let me put this on one more time. Put it on. We're going to go in here. We're going to liquidate the multi-leg, and we're going to do the 25%. and we have to run it down. So we're going to go liquidate. So we're going to liquidate at the bid. We're going to enter at the ask, right? So go up to 25%. We'll put that on there. That's $375. So when it reaches $375 in profit, it's going to take off the sold options. All right. Now there's a 1,475 in there, but we're going to take it off at 375, and then we would put it back on, is the idea, right? Depending on how it is in relationship to our insurance policies. Our insurance policies, because they're 3 days long, I paid $2,300 for them, but the theta decay is not going to decay all $2,300 in today or even within the first couple of hours. So the whole idea is that I'm going to get most of that back when I liquidate those. All right, get most of that back. Now I'm not going to liquidate it. You notice that's why I'm on two different separate tickets. I can liquidate this one, not that one, because if I'm going to put it back on, there's no reason to pay that $50 in spread, right? Plus commissions and fees. I'm going to keep that on there, and then if it's, I put them back on, put on another one. But the insurance policies, because I'm doing kind of a weird thing with the insurance policies being at the money and the sold options actually having the spread as opposed to the other way around, which is more traditional. This is not traditional, which is why we have to give it a different name. I don't know what we'll have to do. We'll have to wait and see. Maybe we'll just take it off at 375 and that's it. We're done for the day. Depends on how far away from the market the market is, away from the options. And again, we're trading the S&P 500 with options. We're not trading the S&P 500 options. I know it's a fine line, but it is a line that we're drawing. Okay, so that's what we're doing there. Now, what is the married put? Let's do a married put. A married put is where you come in and you do the basically the same idea. The concept is only you're going to pick one direction or the other. Okay, so we're going to come in and can I do it here? I don't want to mess up this one. Let's go do it on a different market. And we're going to try the Dow. The Dow doesn't have the greatest options. That's a problem, but we can still example it here. All right, so we're going to come in. We're going to do the 3-day options. See, this is rotten. Look at the spread, $345 the spread. That's why we do. That's why we don't trade options on the Dow. Let's go try to find something that's got some options. Let's go try the. We're in the futures market. If you're over in the stock market, there's options over there, and you could do it over there. Maybe we could open up the stock version and do something over there with the. Because I want to teach you the. Let's try. I want to teach you the married put, and the reason the married put is nice. Let's see what we got going here. We got some good options here. Let's go take a look at Apple. Maybe we'll do a married. Okay. Oh, this is a good example of a married put. This is a great example of a married put. This is the reason that you love the married put is because you're like, oh my gosh, I want to get into Apple, but I know I shouldn't. Lan said buy low, sell high. Somebody said that to me once. Buy low, sell high. I don't know. I can't remember where I heard it. Oh my gosh, where did I hear that phrase? Buy low, sell high. But the market's not low. But it could be in 6 months. This could be low. This market's doing so well. I want to get into the market. Oh, I want to buy right here. But Lan says don't buy right here because we're at the top of the first drive. Oh, we should have bought down here. Why didn't I buy when it was down here when Lan told me to buy? Lan told me to buy down there and I didn't do it. And I was scared. And now look at the market. Oh, I'm feeling FOMO. This is when you use a married put. All right. This is what a married put's for. So what you want to do is you come in and you can use married puts anywhere you want. It's a hedging. I call them soft stops. And that's really what a married put is. It's a soft stop. Okay, it's not putting in a hard stop, it's putting in a soft stop. And sometimes when you trade like this, you can make more money on your hedge, on your insurance policy than you can on the actual option or on the actual shares, because you're going to trade a combination of an option and a share. Now, the reason I want to bring this up is because I want you to think about it in the form of what we're doing with our wild eye crazy eye, right? Because what we're doing with the wild eye crazy eye is we're collecting premium, or we're making money when the market doesn't do anything, and we're protecting ourselves with insurance. Well, why can't we do that with shares? Why can't we do that with a contract over on the S&P in the futures market? We can. So that's how we do it. And what you're going to find is the great place for the married put is when a market is in a situation where you're like, I'm feeling horrible FOMO. I want to buy this thing. I want to get in. I feel left behind. I feel left out. But the market's already got this huge, massive run. and I would be buying at the top at an area of where there's strong resistance coming up, here, and the market's coming up, and I know I shouldn't buy here because it's probably going to fall and then do one of these, and this is going to be Lan's going to say, see that's drive one. There's the counter trend. Buy the valleys, sell the rallies, sell when it's down, buy it when it's down in here on the pullback. But you're sitting here looking at this thing and you're going, it ain't going to come back, Lan. It ain't going to pull back. I know it's going to just keep on going. It's going to go to the moon. I got all this great, wonderful news. Finally, Apple decided to come and play in the arena of artificial intelligence, and they've been left so far behind. And now they've decided to join up with AI, and they're going to go in with open AI, and the Siri is going to actually be able to talk to us like a real person, and it's going to be so great and wonderful, and their stock's going to go to the moon, and I'm feeling left out, and I know it's just going to go straight up. But Lan says don't buy right here because it's going to probably come down, break those blue lights, and then that's going to be a better place to buy. And so I want to buy right now, though, because I feel left out. So I'm going to buy it anyway. I don't care what Lan said. I'm just going to buy it anyway. That's where you put on a married put. All right. So then you come in here and you say, oh, well, I'm not going to buy a call option. I'm going to come in and I'm going to come in and I'm going to go and I'm going to trade it. And we're just going to come in. We're going to buy 100 shares. All right. Boom. Buy 100 shares. So now we have 100 shares of Apple. Oh, I feel better. Oh, I feel so good now. I got my 100 shares of Apple, and I know it's just going to go straight up, and it's not going to come back and break those blue lights. And that's not going to be drive one of a 3-drive pattern like Lan always says. This time's different. This time I'm right, and it's going to go straight to the moon, and it's not going to come back. And I'm going to be right. And you might be right. You might be. It might just take off right here and never come back and never look at those blue lights. Never made a counter trend. Nobody ever wants to take any profits on Apple. They just want to own Apple forever, and it's going to go to the moon. And you could be right. You could be right, but you could be wrong. And it could do what it traditionally always does, which is make 3-drive patterns, A, B, C, D, A, B, C, D, and you just bought it at the very top, right when it's going to flush. How many times have you ever bought something right at the point where it turns and goes the other direction? If you got any experience trading, you've done it a lot. In fact, it's a joke, right? We always say, well, if you want to know when a market's going to fall, just, get in when I get in. When I get in long, you should get in short, and you'll make all kinds of money because I'm always wrong. Well, this is the I'm always wrong trade. This is what you do when you're always wrong, okay? Because the reason you're always wrong is because you always buy high and you sell low. And the reason you buy high is because you have FOMO, and you refuse to buy when a market's doing poorly because your whole life you've been taught you want to do well. Right? From kindergarten, you want to do well. You want to impress your teacher. When you're first grade, you want to do well. You want to impress your teacher. You grow up all the way through high school, all the way into college. You've always been taught by mommy, daddy, and all your school teachers you want to do well. So it's ingrained into your bloodstream that you should only do things that are doing well. And so you think about that in a market too. And it doesn't matter how many times I say it. It doesn't matter how many times, all the great traders of the world say buy low, sell high, buy when there's blood in the street. We don't do it. We only want to buy markets that are doing well because our primary teacher at Sunday school and our kindergarten teacher at school told us to only do well. So we only want to buy stocks that are doing well. So that's why we buy high and we try to sell higher, which is a really hard strategy. But we can't stop ourselves. We want to buy a market that's doing well. So this is where you come in and you put in your put option. All right. So we come in here. And have I driven that point home good enough? So we're going to come in here. We're going to buy a put option. And you don't have to buy a long one. This one here, we might buy one a little longer than 3 days. Let's come out here, maybe 17 days. I like these dark ones because they're the quarterlies. They generally have good volume, good open interest, and the spreads are really tight. So that's why I buy it. And so we were long, and we want to put in we want to buy this buy right at the exact same price. Okay. So a married put is right on top of the option or on the shares that we just bought. So they just got married. All right. They're one and the same. So now you come in here and you going to go ahead and place this, get into this thing. I'm just going to market order in. I know I'm not supposed to do that, but I'm just going to do it anyway. Okay. So now we have our put option. Did I just buy a call option? I did just buy a call option. Rookie mistake. Lan, what the heck? All right. Well, that's not a married put. Liquidate that option. Get it off there, Lan. You just made a mistake. We'll just get out of that one. You got to do a put option. See, I did that on purpose so that you wouldn't make that mistake. Yeah. Oh, Lan made the mistake of buying a call option when he meant to buy a put option. So when Lan made the mistake, don't make the mistake Lan made. See, I did that on purpose. I bought a call option on purpose so I could make a mistake so that you wouldn't make that mistake. All right, so we're going to come in here. We're going to buy this put option. Now, the put option should be less expensive because the market's moving away from our put option, right? It's rallying up, so the put option should be less expensive. That's that put that's that skew. So 300. See, the call option is $487. You have to pay more for the call. Why? Because the market's rallying. But we just bought long shares, so we're cool there. So we're covered on the long side. We're going to cover to the south to the short side. But look at the premium on it. It's $332. So we're going to go ahead and we're going to buy that put option. We're going to buy it right at the money, same places we bought our 100 shares. Now, you have to do 100 shares when you do this because the option is 100 shares. Now, you don't have to because the option right now, when you very first put it on, it's, in this case, it's 0.43 delta, right? So it's actually only 43 shares. That's what delta tells you in the stock market. When you're over here and you're trading in the stock market, of course, in the futures market, you can kind of make that relationship as well. But when here's how I want you to think about delta when you're trading in the stock market. You're trading 43 shares. So if delta is 43, it's going to make or break as much money as 43 shares would have made or lost. All right. So if you're up here and you buy this one, well, that's 72. Delta is 72. So the option is going to make or lose as much money as 72 shares would make or lose. Well, what about down here, Lan? Well, it's 18. So a delta of 18 would make or lose the same amount of money as 18 shares, right? Now, you have what we call convexity. The convexity is the difference between a 185 put, which is here at 18 delta, and a 75 put, or 75, or the 200 put, which is the delta of 73. Now, you notice as it goes down, the delta decreases. So if the market starts to fall, the option is going to make, or in this case, it's reversed. It's probably easier to think about it from a call option, but we're doing put options, so you have to bend your brain a little bit. All right. So what happens if the market starts to fall? The delta is going to go up on your put. All right. That's called convexity. So it'll start making more money as it starts to go in its favor. Right. So a put option makes money when the market goes down. That's why you put it in there. I call it a soft stop. So you're protected to the downside. Now, we didn't buy very much time. We only bought 17 days. So we could have bought more time on that put option and we'd had less time decay at the beginning of the time, right? But the convexity is the difference between the delta 18 down here and the delta 75 up there. Because if the market starts to fall, the delta is going to go up, all right? So it's going to go from 44 right now, making 44 shares. It's going to go up to 75 shares. It's going to start making money more quickly. That's called convexity. All right. So it's going to go 43, 54, 64, 74. It's going to start making more money more quickly as the market goes in the favor of the option. All right. Right now, it's only sitting at 43. And if the market starts to go away from the option, the convexity is going to go down. It's going to go 43, 33, 25, 18. It's going to start losing money more slowly. That's why this works. It's a nice strategy. If the market continues to rise, well, your 100 shares are going to continue to rise, right? And you're going to make money. And the put option is going to lose money more slowly. It's going to go from a delta of 44 to 34 to 25 to 18. And so it's going to be only losing the same amount of money as if you had 18 shares as opposed to 43 shares. But the problem right now is that it's only covering 43 shares of your long position. All right. Because it's making or losing the same amount of money as if you had 43 shares. Well, I don't have 43 shares. I have 100 shares. Okay. There's two ways you can solve that problem. One is you can come in here and you can say, well, I want a hedge, which is what this is, or I want a perfect hedge. What's a perfect hedge? A perfect hedge is where your options delta matches your underlying shares. So if you have underlying shares of 100 and you've got an option on here and it's at a delta of 44, well, you don't have a perfect hedge. If the market starts to fall, you're going to increase in delta, yes, but currently you only have 44. So it's only going to be hedging you half. So you'll make 44 cents for every dollar that you lose. That's why when we do these options, we want to have a shorter period of time so that delta is more sensitive and will increase or decrease. If you push the time out into the future, that delta is less sensitive and the convexity doesn't move up and down quite as quickly. You don't gain as much money or lose as much money as quickly. That's why you push it out in time. That's what causes you to have a slower time decay. All right, it's that convexity on your delta. All right, now if that went over your head, subscribe to Pit News Magazine, and I will document that. I'm going to write it down right here. We're going to do a lesson on. Make a note for myself. We're going to do a lesson in Pit News Magazine on delta and convexity. All right. Next month's magazine will have an delta and convexity article and have that all documented with examples, show you how it all works. So it's all there for you. All right. So now if we want to hedge, which is what we've got on now, we're hedging half of our position. Why? Because we're bullish. We think the market's going to go to the moon. So we don't need a perfect hedge. But if you wanted a perfect hedge, you could come in here and put on a second one. So now you'd come in here and you'd buy another one. So if we buy another one, we're going to buy another put. Now this is 17 days. Yeah, 17 days. Okay. We're going to buy it. Make sure I don't make a mistake. This time I don't want to make a mistake on purpose. All right. So we're going to go ahead and we're going to buy this one. We're going to buy an, oh, wait a second. How come I got all this in here? I don't want all that in there. Oh, I didn't put my hedge on. What the heck am I doing? Rookie mistake number 2. Lan just made another mistake on purpose. Okay. I got to buy my, I put the on there, but I never bid for it. I never sent it into the market. Okay. Good thing it's daily chart. Okay. So we're going to come in here. All right. Lan's going to go ahead and he's going to buy this. So I have to go to the ask and they're asking 350. So I go up to 350. I could bid lower if we were in the real market, but this is the demo. So we have to bid at the ask. They're only going to fill us at the ask. So we place that. All right. So now I have my hedge on. All right. I did that on purpose just so you guys would see Lan make another mistake and you wouldn't make that same mistake of putting your order on there thinking it's in the market and it's not. You have to, when you drop that on there, it's just a little calculator that's showing you where you're at and what you're doing and what all your numbers are. You have to actually hit place order and send it into the exchange. Otherwise, it's not filling your order. Okay. So we've got one now. So we are now with our married put. Our married put is protecting the downside. Now, remember, one option represents 100 shares. But because it has time, 17 days till expiration, and the delta is only 44, even though one option represents 100 shares, it's only trading, making or losing as much money as the delta, which is 44 cents, 45 cents per share. So we are actually uncovered on 55 shares, right? What 55 shares are not hedged. So if the market went down, we'd start to lose money, and the hedge, our stop order, our option, wouldn't be making enough money because the delta, although will increase, it will go up from 45, 55, 66 as the market falls. It's only 1.0 at expiration. Okay, so it's at expiration that matches the 1.0 of the underlying share. So if we want a perfect hedge, this is called a hedge. It's just a hedge. If we want a perfect hedge where we have a delta of the same number of quantities of shares, we need 2 options. 2 options. Because our delta is 44. It's only half. But we want a perfect hedge. So now we have to buy a second one. Now we come in here and we hit buy order. And we're going to have to buy another option. Okay. So we're going to have to buy another option. Now you can do this several ways in track and trade. We can just do that. Or we can come in here and we can say, we can go into our position. We say, wow, I want another one of these. And you can write on here and you can just say retrade a single quantity right there. I want to retrade it. So you just hit quantity 1. You can retrade it with quantity 10 if you want, but we just want another one. We want 2. So we're going to come in here and we're going to say retrade that one. And I hit quantity 1 and it puts it all in there for us, just exactly as the one we had before. We just want to increase our quantity. So now we come in here and again, we have to go up to our ask, which is 350. We say, okay. And that fills. And now we have 2. All right. So now we have a delta of 44 times 2. Oh, that's 88. So that's almost darn near a perfect hedge. Okay, so if the market flushes now, we're going to have a perfect hedge. But what does that also mean? That means that if the market flushes, convexity is going to go up. We would have better than a perfect hedge. The market, it would go up and we'd have a hedge of a delta of maybe, 110 if you add the 2 together, right? Because if it goes up to a delta of 72, well, 72 times 2 is what you'd be making or losing. So this is your perfect hedge. And it's expensive, yes, costs you more money. So you had to pay higher for it, but it's also a soft stop. And that's why this works well in this location. It works well right here simply because you're buying at the very highest point where this market should fall, right? It's got a high likelihood that market's going to fall. We're up there already into the third drive. A drive. So let's come in here and label this. And this is where you need to be good at labeling your markets and know whether you're getting into what are the probabilities, right? We need to understand the probabilities of the market. So this is an A1. And the market went in, let's call that A1. This is right here. This is A2. And then this one right up here, this is A3. So we got A3. Let's arrange those a little bit better so we can go. So this is our A1 right here. This right here, that's our A2. And this right here, this is coming into A3. And we know that A3 is a low probability of success, but you have FOMO and you want to buy at the A3 anyway because, hey, it could go to the moon. There's always that likelihood. All right, these are just probabilities. So now the probabilities tell us that this market's going to pull back, but you wanted to get in right there. So you might make more money on your put options than you'd make on your long position. So if the market does continue higher, then you can peel off your like maybe tomorrow or the next day. You've got 17 days. We might have even wanted to go out farther. It costs us more, but we lose less in time decay. But this is a protection to the downside. If the market now turns and flushes, then you're going to make more money on your option than you're losing on your long position on your shares, and you're protected to the downside with a better than perfect hedge, better than a hedge. You've got a perfect hedge, and the delta will increase, and you'll have a higher than delta 1. You'll have a delta 110 or 120. And so you'll actually, oftentimes when I put this position on, because I get into this situation too, I'm human, I get FOMO really bad. And so I put on this married put like this, and then if the market flushes out from under me, I actually make more money on my hedge than I do on the shares that I have long. That's pretty cool, right? So you want to make more money on your hedge. So if this market flushes out, we got 2 puts and the delta will increase, and we'll make a whole bunch of money on our hedge, and we can take that off. You want to take it off quick because you're losing money on your 100 shares, right? But you're making money on your put, and it's usually the volatility of the market, the implied volatility that makes those things make money real quick. So if it just kind of flushes out tomorrow on the open or something, and you're up, you look at it, you're like, oh, heck, I'm up a lot of money. I'm up $500. Take it off. Take that $500 because the implied volatility will probably slowly decay and drop, and it'll come back to maybe you'll be up $50. So take that $500 if it does a quick flush. But if it doesn't, if it just kind of slowly rises, well, your put option is going to lose money, and your call option or your shares are going to make money. And at that point, you can just kind of say, well, my shares are outperforming the decay of my time decay. You could take one of your options off, or you could just take both of them off, take the little bit of a loss as the theta decay, and move a stop in there, a hard stop at break even, and just let it go. Now you got 100 shares, you got to stop in there, and if the market flushed, you're protected to the downside, making money as the market flushes against you. And that's why it's called a married put, because it's married to the shares that you have and is protecting them, either with one delta or with 2 deltas, and you can make that choice. And you have to understand the advantages and disadvantages of both. And of course, we'll write an article that talks about the advantages and disadvantages of both in the Pit News magazine. Now, if you don't know what these are, A1, A2, A3, how to do your probability statements and look up the probabilities, that's in my book. It's the manual for the class. You can go pick up the book. It's on Amazon, and we talk about the probabilities. It's kind of like when you go play blackjack, you have a probability table, and you can read those probabilities. And here's in the manual of the book, or for the class, this is a class manual, we have all the probabilities lined out, and this is where we go in and see this right here. A1, A2, A3, A1, A2, A3. So this is our B1, B2, B3, C1, C2, C3, and we go in with X1, X2. This is where we kind of start talking about it. We line it all out in here. This is a great little manual for you. Shows you how to trade these probabilities. We got them all lined out. Lots of examples in the magazine, or in the manual. This is the manual to the class. And so it is out on Amazon. You can go buy it on Amazon. Just search Lan H. Turner right here, Lan H. Turner. Just go search for the book, and you can get the manual. And it's got all the probabilities of A1, A2, A3. Teaches you how to count that, and knows when we're going into drive 1, drive 2, drive 3. Right? So we go into drive 1, drive 2, drive 3, and that's a probability statement as well. And that's going to help you know when you're getting up into these upper regions where you might want to put on a married put. All right, guys, that's a married put on Apple because we feel FOMO, we feel missing out, but we're worried it might come back against us here in the short term on the counter trend. So it's a way of protecting yourself against the counter trend, but yet buying it and making us feel good that we now own some Apple. All right. So let's come back over to the futures market and see how our options are doing over here. Oh, well, that's the Dow. Ooh, what a beautiful run. That Dow. Wow, that's amazing. That was off the news event, wasn't it? So our news event came in. Wait a second. Our news event came in at 8 o'clock. That's 8:15. So this was 8:14. Where's 8 o'clock? Clear back here. Ugh. So it went through all that news event and then suddenly it decided it wanted to rally. That's weird. We probably wouldn't have caught that. And it was so smooth and long. It never gave us, well, much of a pullback. Little topping tails. That's what is our only key right there. Look at that. It started to go and it broke from yellow to green with a little pullback on the topping tails, but the bottoming tails stayed flat. And then up it went into the green bars. Wow, that was a beautiful trend. And here we're doing the same thing on the way back down. Put our Fibonacci ruler in there. Go from top to bottom. We're right back here at 61.8 right now, hitting that VWAP. Or is that the VWAP? No, that's the 200 period moving average. VWAPs. Where's VWAP? It's clear down there. So we're way above VWAP. Let's go see what our S&P is doing. Okay, so let's go to our positions. We can see that our insurance policy, 2 days till expiration, is down $37, and our sold options are up $25. So overall, we're down $35, it says. We're still bouncing right around here at max profit. Dead center. Dead center is where we want to be on this thing. We just need time decay. We want a time decay out into the future out in here. All right. So let's do a cone of probability before we let you go for the day. We'll do a cone of probability. Ooh, look at that. Market's way out here. Okay, so what's that line? What's that line, Lan? I don't know. I don't know what that is. Let's get rid of it. Let's get rid of all our drawing tools. Delete all your drawing tools. Okay. So now we're going to come back in. And right here is our orders. And here is our expiration right here. So how do we calculate our cone of probability? We just come in here and we got to add all this stuff up. What's our cost of doing business? Our cost of doing business in here is we're going to make 1,475 divided by 2 is 637 on one, 837 on the other. That's that put skew, isn't it? Okay, so we got the sell put. We collected 635 on the sell call. We made 812. So that's the difference between the two. It's $200 in differences between those two. So that's the put skew that we talked about yesterday. Oh, and I forgot. I got to pull up yesterday's slide and show it to you. All right. So let's come in here and draw our cone of probability. Then we'll pull up our slide. We got more to do. Sorry, we're not ready to go home yet. We're not ready to go close out. We got to go into our spreadsheet and we got to add our yesterday's profit and losses into our spreadsheet. All right, so our cone of probability has got to go out $1,400. All right, so it's actually skewed a little bit to one side, 800 to the call side, and so that means we got $800 to the downside. 6, 7, 800 here, and we got 600 here. So that's the max we can make if our call option hits max profit, and max we can make if our put option hits max profit. All right, so if you sell a put, you want the market to go up, and the max we can make is 637 if the market goes up. If we sell a call, we want the market to go down. The max we can make is 812 on the downside. So that gives us the skew on our cone of probability. So let's come out here, and we're going to put this out here, and it's got to go beyond our, those are insurance policies. So out here like this. Like that. So our cone of probability is going to be a little bit skewed because of that put skew. And that's what we talked about in Pit News Magazine, right? Oh, no. It's going to be in Pit News Magazine. Put skew. We have to talk about put skew. I'll make another put skew article. We got to talk about put skew in Pit News Magazine next month issue too. All right. So now we're going to draw our lines. We're just going to draw our lines in here. We're just going to go from here to here. This is our cone of probability. So the market needs to stay inside that cone right there for us to be profitable. Now I can leave it, but it's got to come back into it. All right. So that's our cone of probability right there. I'm trying to think, is that right? I think that's right. Nope, that's not right. It's got to go double that. because we get both sides. It's just got to stay inside that cone. I think that's right. I'll think about it. Do I have to have both sides? I have to cover both sides? No, because it's on top of each other. So this one can go up 600 and down, make the full. This can go down 8. Yeah, that's right. Okay, so that's our cone of probability. The market just has to stay inside that cone for us to be profitable. And you can say I got it squeezed way down here. What's the chances of it leaving here? Well, we know that. We know the probabilities of that because we got it in two places. First of all, we can come over and we can look at our options chain and we can see the probabilities right in here. So what is this? 5297. So if we go to 5297, 529. 9795 9552. We got to go. Let's go to the call side only. Call side only. What's the probabilities the market's going to go up there? 5297, 5295. That's just close enough. It's saying 50-50 chance. We got a 50-50 chance it's going to stay below that 5290. But that comes back to this other chart that we have for you, where we're going to come in here. This is our cheat sheet. And this is in Pitt News Magazine too. I have a big article on the delta cone of probability. So this one here is the one we're looking at right here, right? Actually, this one. So this is your delta cone of probability. And so as the market drops, right? Actually, this is the one right up here. Sorry, this one. This is where we have our cone of probability. So we have a one standard deviation. So we have basically a 68.2% chance that the market's going to stay inside of that standard deviation. Okay, 68.2% chance. So better than 50-50 that we're going to be inside of that. And that's pretty much what that's telling us. What if it leaves land? What if it goes out? Well, that's what happened yesterday. Yesterday, the market flushed out. Look at this. This is yesterday right here. And so I put on my option right there. See, I put on my options right there. And then the market flushed. I mean, I couldn't have picked it any better. I couldn't have timed it any better. I put them on right there. And then as soon as I put it on, of course, when you put this option strategy on, you want the market just to go sideways, right? You don't want it to move. And it flushed right down, all the way down to here. And I was really sad. I was like, oh, crap, I picked it perfectly. I just destroyed myself. And look at that. That's just kind of a setup that I should have just been aware of. There's drive 1, drive 2, drive 3. Little top up there. So it had a first drive, second drive, third drive. It went all the way into third drive. Of course, and then it came all the way back to VWAP. And that's about where I kind of took out my profits right there, and I made all my money back, fortunately. But I had been right down through here, I had started to hedge my position. So I was taking short positions, and so I wasn't really losing a whole lot of money the whole time this thing came down, because I was kept hedging and making it back, trading contracts out to the short side. And then when it started to come back up, I just pulled the hedge off, kept the profits. And so the market didn't have to retrace all the way back 100% to get back up to my profit zone, because I had a little buffer in there from my hedge. So when it got right up in here, I'd made all my money back, and I just took it off and made 5. Actually, what happened is I took it off and I was still down like $90. So I had to, so then I did a little day trading. Then I just day traded until I made $90 and got myself back to $5 profit. And then I shut it down and I had to walk away. I was, stress of the whole situation. Kind of, you got to sometimes realize when you're done. You're done. So I was done. So today, with this is our cone of probability. The market just needs to stay inside here. But if it leaves, that's okay. It can come up here and then go into it again. It'll come back into the profitability state. That's what a lot of people don't realize, that this market can come up here and your cone of probability expands as time goes by. So if the market comes up here and starts to go sideways, well, it's going to show a loss. So don't take it off right here, because there's a good chance it could come back down. Or even if it doesn't come back down, it just goes sideways, it's going to eventually go back into your cone of probability, right? Into your profit zone, into your profit cone. So it's at expiration where it's got to be inside the cone. And if you get all nervous out here and take it off out here, well, you took it off early when your cone was tiny. Well, you got a chance that it could have come, the market could just still end up inside the cone of probability. Inside the cone of probability is your profit zone. Yes, you're going to make max profit on the one side, but you're going to lose money on the other side. So you're going to have to give some back. You're not going to make max profit unless the market's exactly dead center right here on the green line. So anywhere it goes outside of that, you're going to lose a little bit on one side, but you're going to make max profit on the other side, because you got two of them, right? You're two sold. You're going to collect full premium. It's going to expire worthless, and that's what you want when you sell them. But then we have our insurance policies in case the market does go crazy, which should protect us a little bit. So let's go see what we got here. Right now, our insurance policy is down a little bit more. Let's go see. We also have, if you right click on the header up here, you can also see, you can see the bid ask. You also see the last. And the last is sitting at 245, and the and the insurance policy is at 100. So we're actually up $150, but it won't reflect that right now because it's going to go off of the bid ask. So if you're going to liquidate it right now, that's probably what you're going to see. You're going to see a $45 loss. But in reality, if we go to the last close, this thing, you're up about $150 so far. But we don't get to take that. If you take it off right now, that's just kind of that's your last price. We have to go bid ask. So the bid ask is going to take all other kinds of stuff into consideration, like the spread and the cost of doing business in here. That's $12.50 spread. All this other stuff, and where the bid ask spread is, and the spread is all going to be taken into consideration. That's why these are a little bit different. You don't want to use settlement. That's yesterday's numbers, so that's not accurate. You want to just use either last, which or bid. But if you're going to get out right now, this is what you're going to get. Because see, that's reflected up here in your accounting. Oh, you can't see that. Let's move me down here now. So see up here, it says you're down $55, $60. See, that's reflecting down here in the same place. So you're down $50 up here. Well, you're down $50 down here. So you want to kind of figure that if you wanted to liquidate it right now, your bid ask is what you're going to be taking, and that would be your basic. You'd be basically taking it off with a $55 loss. But if you look at your current last position, oh, now it's changed a little bit. That current last has changed. So we got last, now we're down $102. But we're going to go off a bid ask. So we have to go off a bid ask. So we just need to give it time. Let's get rid of some of these. Delete the arrows. And the market's around. Oh, but it's coming back up, right? Market's really rallying. It's taken off. So it's outside of our cone of probability, which is why we're showing a loss. But if it just stayed right there, it would eventually come back into our cone of probability and we'd be profitable, right? All the way into expiration. And we'd end up inside the cone of probability and we'd actually make money. But Lan, what if it never does? What if it just keeps going up there? Well, that's where you have to mitigate, like I did yesterday. Or if it goes up there, you can just hold on and look for it to come back to the VWAP. That's why we put them on at the VWAP. Because remember, the VWAP's like a rubber band. Market might go up here, but then it pulls back to the VWAP. And the VWAP will be down in here somewhere. And it'll pull back to the VWAP, and you'll end up making money. So it's all just a crapshoot. As like I always say, it's a circus game. It's like going down to the circus and throwing darts at the balloons. But you got the odds in your favor, at least this way, as opposed to against you. So at least we got the odds in our favor to some degree. Okay, we want to put the odds in our favor, and that's where you get that magazine, or that magazine. I keep calling it a magazine. It's the manual to the class. It's like 220 pages out there on Amazon. Just go buy it, search Lan H. Turner. You get the manual, and it helps you explain all this stuff. Plus, we'll put an article detailing this in Pit News Magazine. All right, so we've talked about that enough. Let's come in here, and I'm going to show you the screenshots. All right, so what did we do yesterday? Yesterday, we ran some tests. And we put on a whole bunch of put options, and we wanted to see which put options would protect us the best against a flushing market. Now, in our demo account, what I was talking to you about, I didn't have all these options on in my real money account. I was telling you all the experience I had with my real money account, just getting myself back to zero, just back to break even yesterday. That was all real money. This is our demo account. This is what we did in class yesterday. Now, in class yesterday, we were testing put options, and it just so happened that the market flushed like a toilet, and we made a shit ton of money. Oh, I just swore. Sorry. Damn it. Now, doggone it. Nabbit. Now I got to go confession. I got to go tell YouTube that I said a bad word. All right. Sorry, guys. I didn't mean to let that slip out. But we did make a lot of money. Okay. So the market flushed really hard, and we had all these options, these put options on, because we were testing put option, the skew of the put option, and I wanted to see which one would perform the best. And of course, we just bought a whole bunch of put options, and of course, the market flushed, so we made a whole bunch of money on all of our put options. So that was a great thing for making money, but it wasn't really what our intent was. What our intent was is this is the Wild Eye Crazy Eye Iron Butterfly up here. We got 4 days till expiration, and we got our 0 days till expiration sold, put, and call right there. So we were down $165, and you can see up here on the screen how the market started to fall out of the bottom of the trend. So the market started to flush, and we were down $165 on our sold options, but we were up $137 on our insurance policy. Now, our insurance policy was down $300 on the bought call because the market was falling. So the bought call was going down, but our put option was making $437. So it was up 137, but it wasn't covering the loss of the sold call and sold put. So the sold put was losing $432, and our insurance policy was covering it by $437. So that was actually working right, just like a train on rails. That was perfect. See, our bought put was making 437, and our sold put was losing 432. So those two are matched perfectly here at this point. What was not matched was our sell call. Our sell call was making 267. All right. And that was on zero, and it was making 267, but it wasn't making enough to cover the loss of our buy call, which was 300. So our buy call was 300. It was losing money too quickly. And our put option was, or our sold call option was making 267, which wasn't making enough money to cover the losses of the call option. So that's why we were negative. We were down $30. So overall, at this point, the market had started to flush out. We were still only down $30. So this was working really well. It was doing exactly what we expected it to do, right? And had it not continued to flush like a toilet, this would have turned out beautiful, and we'd have been happy, because it would have probably come back to VWAP and, normal, typical, everyday, run of the mill, iron on, condor, on butterfly, made us a couple $100, $300, $400, $500, and we're happy. That's not what happened. Market took off and dropped down. Now that's what these put options were doing. Now you can see the put options down here. We bought a put, and this one was a 305 put. This was a 295 put, and then this was a 310 put, and this was a 5290 put. So I just kept stringing the puts out along there to see which one made the most money, because I wanted to see which one would give us the best coverage. And so you can see down here the if I can get it in there. I think I went to the wrong. It's not what I wanted to do. I'm on the wrong one. So you can see down here at this point, the put options, we had one at 53.10, and that was 53.10 was way up here. So the one that's way up here is the one obviously is going to make you the most money because it's in the money. So the delta on that one was much higher. Do we have the delta on here? We do. See, it was a delta of 0.61, and this one is a delta of 0.50. So this one obviously is going to make us the most money because it's got the highest delta. So if you buy a higher delta in the money, it's going to cost you more money. So when you're wrong, you're going to have a bigger loss. But when you're right, actually it's the other way around, isn't it? Because when you're right, it's going to lose you the most money, because being right means the market doesn't trend. It goes flat. But if you're wrong and the market trends, well, the insurance policy with the greatest delta, right? Because remember, delta, 61, if we have a delta of 0.61, that's 61 shares for every 100 shares that we have. Now, we're in the futures market, so it's 61% of the full contract. So you have to think of it as a percentage, because one contract is one contract. It's not 100 shares over here. It's one contract. And then you have the delta of 0.61, and that means it's 61%. It's making or losing 61% of the underlying contract. Okay, you can think about it the same way over in the stock market too, but in the stock market it's easier because a lot of people think in the terms of shares, not in percentages. Over here in the futures market, we have to think of it as a percentage. So it's making or losing a 0.61 or 61% of the underlying contract. Now, in this case, we don't have a contract. We have sold options, and the sold options are making or losing the delta, the percentage of the underlying contract. So here we are at the 0 DTE. So you can see right here, 0.29 and 0.71. That's the put skew that we're testing. See, the sell put was at a delta of 0.71, but the sell call, and both of them are right on top of each other. Notice that they're both right on top of each other. They're a 5,300 call and a 5,300 put, but look at the delta difference. One has a delta of 0.29, one has a delta of 0.71, and they're both at the 53, the 53 strike. So that's a huge huge skew between the call and the put, and that's where we end up getting screwed up on this strategy, is because you go in and you put them right on top of each other. So the question is, why are we putting them at the same strike price? Shouldn't we be putting them at the same delta? That would make more sense, right? I mean, think about it. Why are we putting them at the same strike price? Why do we even care what the strike price is? We shouldn't. We should be putting them at the same delta. So if we have a delta of 71 on the sold put, we should try and find a delta of 0.71 on the sold call. Well, that means we'd have to push it into the money, and they wouldn't be right on top of each other. So it'd be a wild eye, crazy eye, iron condor, not a wild eye, crazy eye, iron butterfly. So now we need to test those, Bruce. Bruce, we need to test a whole bunch of wild eye, crazy eye, iron butterfly condors now. And we need to go off of the delta, not off of the strike price. And we need to match the deltas, because that's what's giving us this skew difference here. And that's why our insurance policy is not covering us properly. And that's why we're losing money when the market runs. It's because the deltas are screwed up. All right. And that's what this shows us. That's what we learned yesterday. Yesterday was a very important day, because we learned by putting on all these put options in here at different strikes and at different levels and different deltas, which deltas were performing in the right way. So even today, where we put on our wild eye, crazy eye, iron butterfly, which was actually an iron condor, we tried something different in this one. I'm not sure exactly how it's going to turn out. You can see right now, I mean, it's doing okay. We're only down $25, and it's outside the cone of probability. It's only outside the cone of probability by $25. But look at our put skew. Let's see. What have we got here? Let's go look at the deltas. Look at this. This is horrible. This is terrible. Look at this. We got a put skew in here. We sold the call, and it's at a delta 74. Well, that's not fair, because that's not when we put it on. It's what it's doing now. It's got a delta of 74 against our put, which is a delta 38. So the skew on those is, I don't know what it was when we put it on. I didn't take a picture, so I don't know. I don't know if it was closer. But it certainly, well, and that might be what we're looking at here too, right? I mean, we have to admit that might be what we're looking at here too. Maybe the deltas were a little closer. Let's go look at what they are right now. What if we were going to put it on right now? Because oftentimes I'll put it on after class is over, right? So if we're going to come in here, and let's say I was going to put one on right now. I'd come in, let's say, okay, we're going to do 3 days until expiration. That's Friday. And I wanted to let's do both. I'm going to look at both calls and puts. And so right there next to each other, we got $1,550 on the premium for the $52.90 at the money call. And we got $52.90 at the money put. Just moved. So the market's moving on us a little bit. And we come over here, and what's the deltas? The deltas are 53 and 47. Well, would it be possible for us? See, that's not too bad. 47 and 53, 47, 48, 9, 50, 1, 2, 53. So the delta is 6 apart. We would be better off if we could find the deltas at the exact same price. Let's go look at, if we go to traditional, we don't have, we do have delta, but deltas. I hate the way this, there it is, delta. Okay, so we got a delta of 0.51 and a delta of, so if we were to come in here and let's say, okay, we want to sell this one at a delta a 0.50, we would want to also sell one of it a delta 0.50 here. So it's actually, well, they're both 52.95. So right now the deltas are exactly the same. So the deltas on those two are exactly the same at 52.95. But in the mornings when we've got a wilder skew, the deltas are not the same. So I think we need to take that into consideration. I think when we put these things on, we need to look and make sure that we're doing delta the same, not just the strike price the same. So we may have to move this off one like this to get it to be the delta the same. It's going to still be relatively close. We may have to even go 2 if the skew's a little crazy, which would be a condor, right? It wouldn't be a butterfly, but we'd be selling it at an equal delta. And I think that's more important for us than the actual strike price itself, where the deltas are at, because we need to be covered by the deltas. One's got to cover the other. And that would mean that we would need to put our wings on out there, and we'd need to make sure that our wings are at the same delta too. We want everything at the same delta, not the strike prices. See, we get myopically focused on the strike prices, and it's not the strike prices that are affecting our profit and loss balances, it's the deltas. And if our deltas have a bad skew in them, that's why we end up showing a big loss in one direction versus the other. I think that's a key to putting these things on. We're going to watch that. Okay, that's something we're going to have to test. I'm going to write that down. We're going to go in here and we're going to go the delta skew. Okay, we got to write that up and we got to test it. All right, I think we're kind of dialing these things in and trying to get them a little bit more perfect. A little bit more perfect. All right, so that's what that one was. Let's look at the final. What's this one? This is when the market started to come back. So you can see in here, this is where the market started to come back. And you can see that the bought call and the bought put, we were up 350, but we were down 535 on our sold options. So we're down 535. This is after the market really tanked, right? It started to come back on us a little bit. Down here is even worse. But our insurance policy only covered us 350 and we lost 535. So all in all, that's really not that bad. I mean, we had it's $200 loss. And considering the fact that we've had the probabilities with these things have been making money hand over fist, we only had 3 losers last month. To have the market go that crazy and only lose $200, and that was if we liquidated right now. I mean, the market came all the way back to VWAP and ended up profitable. So I think I got that. Let's go look at the next slide. This is a good strategy. I really like it, and I want to dial it in, see if we can't tighten it down just a little bit more. We're getting down to that 80, 90 percentile, right? We got 80% of it, 90% of it. We're just trying to pick up that last 10% and dial this thing a little bit better. See, this thing came back, started going sideways. It's not quite a VWAP right here. And so we were up 187 on our insurance policy, and we were down 127 on our sold call and put. And this is where I liquidated. This is where I took everything off because we were back to profit. Now, the market did actually cross the VWAP and continued to rally, and it went higher. If I'd have waited a little longer, we'd have had a greater profit, a little bit greater profit, because this came back all the way to the VWAP, which it's almost at the VWAP now. But it started bouncing off the 200-period moving average. I had got back to profitable zone, and I was like, hey, it's profitable. And we were down $200. So we're back to profit. We made $200. And I was not hedging. I wasn't doing anything here. I was just letting it run because I just wanted to see what it would do. And so we ended up with all of our options in here because we put on a whole bunch of put options. We ended up with 2,522, which isn't really fair. We don't really need all those put options. That's not what we were trying to do. We weren't trying to say, oh, look how much money I'm going to make because I put on a whole bunch of put options and then the market really fell. That's not what we were doing here. We were trying to figure out which one of these insurance policies would have been better for us, which one of these options would have performed better for us. And you can see the ones that were further deeper in the money obviously would have done that, which is what prompted me to do the Wild Eye, Crazy Eye, Iron Condor today. I'm like, well, let's push these insurance policies further into the deltas. Okay. And actually I didn't. I pushed them. How did we do this one? We want to push them into the deltas. That's what I meant to do. I got to write that note down. All right, guys, here we're going to push these into the deltas further. Delta positive. We want to go into a delta. We want to be probably delta 60 on these things. That's what that's showing us, isn't it? Right? So I went delta 40s. So I actually did it backwards from what I wanted to do. So this is actually not what I wanted to do. Is it? No, because we bought our insurance policies at a delta 50 and 44. So we've still got a matching delta. So we got to look, see right here. We got a sold delta a call that we sold with a delta of 0.67 and a delta of 4.6. This is delta 5.7 and 4.3. So our buy put has to cover our sold call. And we're trying to cover a sold call with a delta of 0.69 with a, or am I doing that wrong? Our sold call. No, we're trying to cover, look at that. We got a delta of 0.43 trying to cover a delta of 0.68. If we buy the put, the market, we make money when the market falls. And if we sell a call, we make money when the market falls. So the buy put needs to cover the sold call. And right now the delta of the buy put, which is the insurance policy, is only covering it at 42 and we're losing at 71. So we're losing twice as much money as we're making. That's the problem we got to solve. I think we just had a breakthrough. We don't want the wings on the outside. We want the wings deep on the inside. One click inside. I think that would help us. I think I put them at the money, didn't I? And I put the wings outside. That's what we did here. Let me think for a second. It would cost us a lot more money. It'd be more insurance. We wouldn't have to hedge. This would be our hedge. We wouldn't have to sit here and run the autopilot to hedge. We wouldn't have to. That's what I'm trying to eliminate, because it's hard to be you have to be a good day trader to be able to hedge, because you have to know where to hedge at, right? So yesterday, I'm a pretty good day trader. I'm not bragging, but I'm a pretty good day trader. And I still had times where my hedge actually ended up costing me more money than it helped me. Now, overall, in the end, I'm bragging. I was able to do it. I did my hedge and I brought it back, and I did. But what about a guy who's not a very good day trader? He wants to make money too. So that's what I'm trying to figure out. It would be better if we could figure out a strategy where the guy didn't have to day trade. So if we push those insurance policies up a little bit, you're not going to make as much money, but you're not going to have to. But overall, in the longer term, rather than trying to do all of your hedging with maybe the magic stick or with the autopilot, or just having the market blast out of your. See, I'm trying to take this concept of the married put, and with the hedge and the perfect hedge, and I want to have a better hedge. And you're like, well, pay more money for it. Yeah, pay more money for it. But I want it to be sensitive, so we have to have a short time to expiration, but I don't want it to be. That's what I'm noodling on here. That's what I'm brainstorming with you guys here. So I think I want to try tomorrow. I'm going to see because it costs more money to put them in the money, but does it cost more money? Which costs more money? Does it cost more money to have a shorter theta, which is more sensitive to the time market, right? And then put them in the money? Or is it more expensive to put them not in the money and have longer theta? So it's going to be a trade-off. If we want to protect against a market that's going to take off. That's the problem. That's what we're trying to do here. And we're going to have to pay for it. It's not going to be free. But then we're also not going to have to do hedging, because that is our hedge. Because when we manually hedge, like I did yesterday, it can actually end up being worse for you. You could end up losing more money on your hedge than you're making or saving yourself on the trade. Because if you're not very good at day trading, or the market's not, you might be good at day trading, the market just simply doesn't perform for you in that regard. Right? That happened to me a couple times. I'm not a bad day trader, pretty good at it actually. And the market just still turned and went up, and I had a hedge to the short side, and the hedge ended up costing me money, and I had to make that back up in either another hedge, or I had to make it back up now the market had to retrace farther for me than it did before. It actually hurt me to put on a couple of my hedges, because I lost money on my day trade by scalping or trying to take a short position. And then I got in, and the market started to fall, and then turned around and came back, stopped me out. I got stopped out with a loss. Well, that's an additional amount of money that I had to have the options pay. So the market now had to come back farther than it did before. And that's because I was trying to hedge and I lost on the hedge. Now, overall, I made more money on the hedge and it helped, but there is a situation where that could happen, right? And we try to eliminate some of these variables. And I know I'm just dragging things out because I'm just sitting here brainstorming, trying to think of all these things, of ways that we could do this. And I'm doing it out loud here in front of you guys. I don't know, hope I'm not. Hopefully you're following along with me and I'm not just wasting your time, but this is what I kind of think about all the time. I'm trying to figure out ways to make it easier and make it easier for guys who don't know how to trade and make it easier for me. I want to make it easier for me too. I don't want to, that's why we try all this stuff. All right, I think that was the last one. Did I pull up? Okay, that was the last one. So that's where we ended up yesterday with all those options. Now, we made all that money on these options because we bought all these put options. So this is my dilemma. The dilemma I have is, do we put all those profits into our spreadsheet? Because we have to go and put our profits into the spreadsheet. And we were just testing. Now, the thing is, I'm like, Lan, it's not really fair that you come in here and go into your spreadsheet and say those were your big old, look at all those big profits Lan made. Oh my gosh, we made all this money. Oh, that's the wrong window. We made all this money. Look, we come in here, we made $2,522 yesterday. Yeah, but those were all testing. And the real trade was this one here, 127, 187. How much did you really make? $50. $50. If we had been doing that with real money, we'd have made $50. So why are you going to come in here and put $2,522 in there that you made $5,222? And I'm going to show you why. Because if you go back to June or in May, look at this. I had 2,000. I had some big, huge losses in here, and those were from our experiments, right? So when we lose money in our experiments, we still log it. We still have some big losers. Look at that. This day was a day we did lots of testing. Too many options, examples. We took all kinds of straddles and strangles. We put them on, we took them off, and we lost a bunch of money practicing. We lost $2,130. Well, would we have done that with real money? No, but we still logged it as a big loss, and I have to show it in my books. So that's my justification for coming in here and saying, well, we made $2,000 in our testing. We might as well put it in the spreadsheet, even though we know it's not the real numbers. But hey, we made $2,000 yesterday in our options. The options futures, we made $2,522.50. Do we get to count it? Yeah, we get to count it. We count the losers when we do testing. Why not count the winners when we do testing? So we're going to come in here, we're going to make a note, and we're going to be honest. Okay, in our note, we'll be honest. Actually, we really only made $50. Actually, we really only made $50. We were running a bunch of tests, and we added in a bunch of put options, see which one performed the best over time for our insurance. The market just happened to drop like a rock and paid handsomely. How do you spell handsomely? Just like that? Close enough. Handsomely. Actually, we really only made $50. We were running a bunch of tests, and we added in a bunch of put options to see which will perform the best over time. Insurance policy, the market had just happened to drop like a rock and paid us out handsomely on our test options. Not have done that. Really. All right. So we'd be honest about it. We got to put that in there. And I don't think we day traded, so we don't have anything there. Not sure what we did there. So that's all we got. That's our spreadsheet. And for those of you who are subscribed to Pit News Magazine, you get this new spreadsheet. I got it all filled out for this month. And document recovery. Excel has recovered the following. I don't know. How do I close that? Okay, so I got this all set up for you. You can see we got our June in here. We got our calendar. So today, that was Monday. So we get to come in here and make that a big green day. All right. And we got one winning day, 0 losses. All our divide by zeros. We got to have a loser to clear that out before that'll fix. But there we go. So this spreadsheet is available for all of you guys who have Pit News Magazine. You get this for free every month. I update it and then send it out with Pit News Magazine, and it's in the email. So when you got the email yesterday, down at the bottom there's a link. You click on it and it'll download this new spreadsheet. I don't know if you want it because you probably got the old spreadsheet and you probably got all your numbers out here and you don't want to update to the new spreadsheet. I understand that, but for new guys who are just getting started, this is the new spreadsheet. Oh, there's something we don't need. We can close that out. Let's see, that sheet is deleted. I was just running some tests there. All right, so let's save that. There's our spreadsheet. There's where we sit today so far. So far, so good. Okay. All right, where are we at? Well, we're up. We're up $87.50. We got a stop order on that. Our limit. Did we put our limit order on there? We do. It's yellow. We have a limit order in here. We can come into orders. We have our limit order. Take that thing off. Wait a second. We have 2 orders in here. Did we put them all on the same ticket? No, how come we have 2? Days till expiration 3. I don't want all that. I don't think I want all that. These are open orders. Let's come in here and delete that multi-leg. We don't want that one. We just want this one. This is the limit order to take the profit off. Okay. So what do we said we're going to take it off at 25%. It's obviously not quite there. So we're up $62 because our insurance policy is down 50. Our solds are up at 125. See, it came back into the cone of probability. But if we would have liquidated out here when the cone is small, say, oh no, we're losing money, let's take it off. That's what all those guys are doing over on that other channel, right? You go watch those other channel because they're trading S&P options. They're not trading the S&P with options. They're trading S&P options. And so as soon as they hit their, oh no, we're losing money, boom, they hit their stop, they take it out. They're out. They lost money. They took a loss because they don't understand this concept. They're not trading the market. They're just trading the options. And the options were showing a loss. So, hey, I'm taking it off. But if you wait, the cone of probability expands throughout the day. They don't see that. All they see is that cute little graph, right? They see this. They see this little graph. It goes like this, right? They see that little graph. And then they got their little break-even points like this. And as long as it stays inside the break-even points, they stay in the market. But as soon as it goes out here, oh, no, I'm losing money, they get out. It left the cone of probability, but it doesn't mean it can't come back into the cone of probability, right? So how do I close that out? There we go. Delete all doodles. So that's what's happening. And then you can roll. There's all kinds of things you can do. And the cone's real small in the beginning. So, of course, it's going to leave your cone. Of course, it's going to lose money. Sure, it's going to show a loss. But the idea is that's why we do it around the VWAP so that it comes back to the VWAP and comes back into the cone of probability. And so now we're up $87 and they liquidated and took a loss. I don't know. It's just different strokes for different folks. So, all right, guys, let's give you, I got a Sunday school lesson for you today. So let's bring up our Sunday school lesson. All right. So here's our Sunday school lesson. Avoid the large commercial traders. Now, this is when you're day trading over in the stock market and you're looking for opportunities. We generally want to stay away from the big commercial traders. But when we're trading options, we want to be where the big traders are because they're the ones who are providing all the liquidity to the market and giving us the liquidity that we need, right? So this is kind of it's a focused comment. Although they may have a lot of volume and open interest, huge popular markets are usually dominated by professionals and computerized trading quants. Retail traders like you and me generally stick to small cap markets under $20 per share. So if we're going to go out and we're going to day trade, right? We're going to go day trade in the stock market, then that's the Sunday school lesson. You kind of want to stay away from the big, huge commercial traders. But I like to trade the S&P 500, which is where all the big commercial traders are at, and I like to trade them with options. So that is a little bit of a misnomer. This is only if you're going to be day trading. If you're going to trade kind of like, like Ross Cameron, this is kind of what you want to do. Markets generally take the escalator up and the elevator down. Keep that in mind. We generally fall much faster than we rise. People bail out of markets. They don't bail in. All right. So markets fall much faster than they rise. And all of your friends are going to be trading in the small caps if you're going to do day trading in the stock market. That's where all your friends are at. But I like to trade options, so I like to trade the S&P 500 where all the big commercials are. So, and you've seen us do that. We'll do that again sometime. It's a lot of fun. We pull up that FinViz and we go find the markets that are trending really hard, and we buy options on them. We day trade with options. It's a lot more fun I think it's a lot more fun than what Ross does. I like Ross. Ross is really awesome, but I can't trade the way he does. I just can't do it. Oh, look. We're up $87. The market's falling past. Now it's coming down to the bottom of our cone of probability. All right. Just let it go. See what happens. I'll let you know tomorrow. All right, guys. We will see you tomorrow. If you liked what we did today, go ahead. Hit your like and subscribe. And hit the thumbs up, the little bell. Yesterday, we didn't get very many thumbs up. So it made me feel like maybe you're not interested in this stuff anymore. Maybe we just need to go do scalping on the 1 minute chart, and maybe that's what makes everybody happy. We just go scalp 1 minute charts, and we won't go into all this deep dive into options and deltas and all kinds of weird, crazy stuff. This is pretty advanced stuff. So I know probably a lot of people are just like, I don't know why I'm sitting here watching this. This stuff is way over my head. The reason I'm doing it is because I'm trying to knock out all the really hard stuff, so I can just tell you, do this, and it's going to work out for you. Because we've done all the hard work. We've thought through it all. This is where the best odds are. Just do this. And then you can say, okay, I don't know what the hell I'm doing, but I'm going to try it. And maybe you'll make a little bit of money. So I just want to make it easy, but I want to kind of explain why I don't like people just to do things just because I said to, and I don't like people to do it just because it's a model that they saw on the internet. I want people to know and understand why we're doing what it is we're doing, and that's why I'm sitting here brainstorming with you about all these deltas and where the money's in the money and at the money in the skews and all this kind of stuff. I want you to understand it from a point of view of why are we doing this, and why is this the best setup? Why is this the one that makes the most money? Why is this the one that over the long period of time works out best for us? And this is why, because we're going to go through all this stuff. So if you like that kind of stuff, give me a thumbs up and we'll keep doing it. All right. Because it's what I want to do. And this is my channel. So I can do what I want to do. All right, guys. We will see you tomorrow. Same time, same bat channel, same bat cave.